Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to explore the Elder Force Index. This is an indicator that combines both price and volume to help you understand the market momentum and trends. So you have to stay tuned as we break down how it works, walk you through a step-by-step day trading strategy that can help you with your trades. We start by understanding what this Elder Fox indicator or Elder Fox index indicator is all about. And this is a technical indicator that measures the strength of price movement by combining two key factors: the price changes and the trading volume. The combination gives you insights into the momentum behind market moves. Whether buyers or sellers are dominating, the formula is straightforward. It multiplies the difference between the current price and the previous price by the volume during that period. So when you see a positive value, this indicates buying pressure, while a negative value indicates selling pressure. When the force index is close to zero, it signals a weak trend or indecisive movement in the market. So this is basically what this Elder Force Indicator Index is all about. Now let's see how we can trade using the Elder Force Index Indicator. We'll come up with, I will explain our trading strategy using this indicator. We begin by setting up the Elder Force Index on your chart with a 13 period EMA for smoothing. So checking the settings to set it. As you can see, it is already at a fixed length of 13 period EMA for smoothing. So this is the setting for your Elder Fox indicator. Then we have to add our exponential moving average on the price chart to identify the overall market trend. And we are going to be making use of the 50 period exponential moving average. This combination helps you to separate trending markets from periods of consolidation. As we can see how price is being smoothed out with the EMA on my chart. When trading, we have to focus on the relationship between price and the 50 EMA. If price is above the EMA, it simply means we are in an uptrend. And when price is below the 50 EMA, it means we are in a downtrend and we are looking for selling opportunities. If price is above, don't forget we are only looking for buying opportunities when price is above the EMA. So for entries, we have to make use of the Elder Fox Index to confirm momentum. How do we do this? In an uptrend, first of all, find out if we are in an uptrend. Check where price is trading above the EMA. When price is above the 50 EMA, we are satisfied that yes, we are in an uptrend. So we'll be looking for just buying opportunities. We would have to wait for the force index to cross above zero. And at this moment, when price is above the 50 EMA, we wait for the index to cross above zero. As we can see this line on the force index, this is the zero line. We wait for when price crosses above the zero, and the moment price crosses above the zero at this area, this would be a good trigger for us to go for long position. At this moment where price came above zero, we will be entering our buy trade at this area. Now for a short position in a downtrend, you first of all confirm that price is trending below is moving below the 50 EMA. And as we can see in this area, price is trending below the 50 period moving average. We will look for our short position when our first index drops below zero. You can see in this area, when it drops below zero, this will be a good selling opportunity. As you can see, remember this line crossing over, this dotted line signifies the zero line. So when the first index is trending below 0, it signifies a strong bearish trend. So this will be where we'll be looking to enter our short position. Now, how do we exit? We exit our trade by monitoring the changes in the first index. For a long position, we close our trade when the first index turns negative or drops below 0. So the moment you buy at this area and you notice price is about crossing to 0, at this area where price is crossing back to 0, this will be where you'll be looking to exit your trade. This will be where you'll be looking to exit your trade at the point that price is crossing over back to 0. The same with your downtrend. When you enter your selling position on your downtrend, the moment you would want to exit your trade is when price gets back to your 0 level. The moment price gets back to your 0 level or crosses above 0, this will be a signal for you to exit your trade. So at this point, best place to enter would be at this area when price dipped down in price, and we can exit when we notice price shows us a sign of reversal or when price crosses above 0. At this area will be a good place to exit your trade. How do we place our stop loss? We place our stop loss just above the previous swing point. Just above the previous swing point, or you can set it above your EMA. Just to give yourself enough room. You can put it 10 to 15 pips above your EMA in terms of a buy trade, a sell trade. Then in terms of a buy trade, you put it just below your swing point or below your EMA, giving it enough room, at least 10 to 15 pips from your stop loss, from your entry level, from the swing low level, just to give it enough room, or from your EMA level. This is how you exit, and you have to always monitor changes in your Forex index. The changes would help you to know when the market would want to move against you. You can also use divergence between price action and the first index to refine your strategy. For instance, if the price is making higher high but the first index is making a lower low, this can be a signal for you to exit your trade. Or when the first index is making a lower low and price is making a higher high, this is a good opportunity for you to leave the trade. Now let's see where we can spot a good example when price is moving directly, indirectly to where our chart is going to. At this area in price, we can see price is making a lower low at this area. We can see price made a lower low at this area. This was a low, this is a lower low. But when we look at the first index, it's just giving us a straight line signifying a higher high situation at this area. This is a good example of a divergence. This signals that price is moving to the upside. This signals a good buying opportunity, a reversal, a signal that price is about to reverse from this bearish move back to the up move, going to a long trade. So this is a bearish reversal signal, a bullish reversal signal rather. Let's not confuse ourselves. So when you see a divergence, it can potentially signal a reverse in price. Now, the next thing we have to do is to check for a bearish divergence. If we look at this area in the market, we can see that price was making a higher high, but the indicator, our first index, was making a lower high. This is a bearish reversal, signaling that a reversal might occur at this area and price will go to the downside. So this is basically how we can capitalize on divergence using our first index with price action. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.